Okay, guys, as I was explaining to you that you only need three things over here to make sure that you place your orders. As long as you have successfully analyzed your accurately, you analyze your charts. Now you are ready. So let's look at what that example how it portrayed. Remember we spoke about setting like your buy limit orders and entry and everything. Yeah, I know that sometimes it might be very the third stop loss may look intimidating. However, we do not get emotional. Remember, you need to detach yourself from the charts or the trade. We know that if our stop loss is hit, we go back again. We just do what we do best. We analyze again. We analyze our analysis was wrong, and then that is the time to reassess the market again for a new entry. We wait again. The best thing to do in this market is just to wait. You wait for a better setup again. You don't rush after, or you go after the trade when you've lost. No, the market will never leave you. It will always give you opportunities after opportunities after opportunities. So you just have to be patient. Wait for the fat one. Wait for the big fish, right? So wait for the better setups, or simply move to another instrument. Simple as that. You don't just have to wait because you've lost or you've missed. You might find that on the other instrument that they correlated with each other, it hasn't left as well, so you can just participate on that one. Look at how that trade set up. Look at this. Do you see where it was when you were analyzing? Do you see where your price was at? You analyze, you put your buy limit entry orders and everything, and you were risking, like you were looking for this to go and take your profit over here, right here, right? This was a take profit. Now look the outcome of that trade, how it portrayed. Look, beautiful. It was here when you analyzed, but then you waited because you knew where is the entry point. You waited for this moment. It tapped in, just 2 pips, drawdown. The next thing, boom, it keeps on going. Once it gets over here, this is where you take 80% off. You let the winners run, but you take 80% off, just in case for that. Sometimes you might be saying, hey, it will continue, not only to find out it will reverse. So it is better to take 80% of your trades off and let the winners run. By the time this candlestick close, then you know that you are safe. You can take everything, close everything, and then you withdraw your profits, your take home. This setup, as you can look at it, I once spoke before earlier on that this type of setup, it was going to be like roughly 1:15 or 1:10 or 1:20. And imagine now, this is positive, like the position was triggered perfectly with only 2 pips of drawdown, resulting in a massive 10 plus risk to reward profit. You get the point? So a textbook example of order block mitigation and continuation. So this is like, if we were to run this one, we were like 1:11. Imagine. So now that we are done with the order block strategy or order block entry level stop loss placement, so now we're going to, or maybe someone might be saying, but Buntledi, how do I know, or what if the order block that I've identified is very big? So what do I do next? You do what we call order block refinement, right? What is an order block refinement? An order block refinement is like, as we previously mentioned, it is the best to locate order blocks on higher time frames. But however, that typically leaves you with a very range to place your stop loss. You might find that the stop loss where you're going to place is very big. So what do you do in that situation? With this strategy, it is not necessary to have a stop loss larger than any 10 pips. Like no one is supposed to risk that much. So maximum is 10 pips. But if you find that you have analyzed your markets and you find that the place where you're going to for your entry and your stop loss placement, the gap between the two is more than 10 pips, you do what we call order block refinement. What do you do? In order to shrink the gap between entry and stop loss, we must refine the order block by utilizing lower time frames. This is what we call top-down analysis. You move from your daily time frame, then 4 hour, then 1 hour, then 15 minutes, until you get the point. But the best but order blocks, no, I was just like drinking water. So the best order blocks, you find them from daily, 4 hour, and 1 hour. Then, for example, in a below, the example below, we can see an order block on the 4 hour time frame that was responsible for a break of structure, BOS. We label this our point of interest. You see, check this out. Now, remember, we've got our checklist that we're looking for. First thing first, there must be break of structure. And then secondly, the break of structure, like the highest high was this one, and the candlestick closed above. It closed above. So this huge candlestick, this is like the first instruction that you're looking for. There was a massive impulsive move to the upside that broke the structure. Okay, cool. Next thing you do, what is the order block? You're looking for the next order block, the last candlestick in the opposite direction prior to what? To the impulsive move. Which one is that? There it is. Here it is. This was your impulsive move to the upside, and this was your break of structure. Now what do? You mark this and wait. You mark this and wait for what? For price to retrace back to what? To this point, right? After that has happened, that's what's going to happen. You need to look for entry setups. You have marked you've analyzed your charts, and then after you've analyzed your charts, then you do what we call order block refinement. You might find that your stop loss placement over here, it's way too big, it's more than 10 pips. So you refine it, you zoom into a lower time frame. Remember, if this was a 4 hour, you go down to 1 hour. That's what you call. To begin our refinement process, we need to perform the top down analysis, as I've mentioned prior, and drop down to a lower time frame. From 4 hour, we drop down to what? To 1 hour. From our 4 hour, we go down to what? H1, which is what? Our 1 hour. That's what we're going to be looking for our entry setups. So that structure, the very same structure that I've showed you, look at this. Look at this. Now, that last candle, this is a series of last candlesticks coming down to what? To the in the prior to the impulsive move. Now, this is our point of interest, but what are we looking for? We have the price is still coming to our point of interest, so we need to make sure that we have our trade set up quickly before it comes and leaves us. As soon as we get into 1 hour time frame and zoom in, we can see that 4 hour bearish candle is actually comprised with smaller 1 hour candles. We can now adjust our rectangular zone to fit the last bearish 1 candlestick, 1 hour candlestick. By doing this, we drastically shrink our zone from 24 pips to what? Over 9 pips. That passes our what? It confirms our 10 pip. Remember our rule, we said that we're not going to risk anything more than 10 pips. As previously discussed, our maximum stop loss is 10 pips. So this trade setup now fits within our parameters. It's important to note that as soon as the criteria is met, we must stop refining the process. So once you identify that the stop loss placement is not more than 10 pips, you stop right there. You don't over refine. You stop right there and start looking for entry setups. If we get too greedy with our entries and over refine them, the zone, we will often miss opportunities and watch price take off without us. So we have to make sure that once we calculate that 10 pips, then if the setup falls under our parameters, that's when we know that we stop right there and we continue on.